It looks like the American borrowing binge may have finally ended, or at the very least, it is taking a breather. The Federal Reserve recently released the numbers for consumer credit as of May 2023. And over here, you can see that the non-revolving debt numbers dropped by 0.4%. Now, obviously, that is not a huge drop. However, it's significant because this is the first time that non-revolving credit has decreased since April of 2020. Now, obviously, revolving debt was up 8.2%, but compared to prior numbers of 13, 14, 9, 13, 14, 16, 15, an increase of 8.2% is well under what we've been experiencing for the past couple of years. So what is the difference between revolving credit and non-revolving credit? Non-revolving credit is going to be things like motor vehicle loans, loans for mobile homes, student loans, boats, trailers, vacations, and it can be secured or unsecured. Now, a slowdown in revolving credit and a decline in non-revolving credit is obviously a stark departure from the last couple of years' trend. But there may be a good reason why this is happening. Over the long term, the trend for all debt is to go up in the United States. Since 2004, we've seen a massive increase, with student loans going from 0.26 trillion in 2004 to 1.6 trillion in 2023. Credit cards going from 0.69 trillion in 2004 to 1 trillion in 2023. Auto loans at 0.72 trillion in 2004 to 1.5 trillion in 2023. But despite the fact that that long-term trend is up, there are obviously going to be periods of time where it is down. Like the period of time from 2008 through about 2012, you had most forms of debt declining. Similarly, at the start of 2020, there was a slight dip down in loans as well. So two different time periods in recent history where total debt dropped, and for two very different reasons. Obviously, in 2020, it's very easy to see there was a large amount of stimulus sent out to Americans. Extra paychecks, working from home, there were massive asset valuations through the roof. And so temporarily, people's incomes were able to go up, and a lot of this was used for individuals deleveraging. But obviously that story ended pretty quickly as we see debt started skyrocketing from there across all categories. That's because people bought into the great times. They looked at all the money flooding around. They started taking out home equity lines of credit, second mortgages, buying used cars left and right out of FOMO, and that debt skyrocketed. But what happened in 2009, 10, and a little bit in 2011 was a little bit of a different story. Obviously during that time was the great financial crisis. There was a big recession going on, and lending standards tightened like crazy. So it was very difficult for people to get new debt. And if you can't borrow at the same rate as you're paying off your old debt, which debt service costs include paying down that old debt, then on net, yeah, you're gonna have deleveraging that takes place. Now, considering the differences between what happened in about 2010 and what happened in the beginning of 2020, what is going on right now? Because the change in consumer credit is dropping, especially with the non-revolving credit portion going negative for the first time since 2020. But first, a word from today's sponsor, I Trust Capital. Investors today face all sorts of new and unique risks. Invest in stocks and risk a stock market crash. Invest in bonds and watch the value of those bonds drop as interest rates rise. Keep your money in cash and watch inflation eat away your purchasing power. Invest in crypto and watch frauds like Sam Bankman-Fried steal all your money. This has many investors looking to alternative stores of value like gold and Bitcoin. The problem with this is that most investors are not able to access gold and Bitcoin. This is because most people have most of their assets tied up in their retirement accounts. And most retirement accounts do not allow you access to things like gold or silver or Bitcoin. This is where I Trust Capital comes in. I Trust Capital allows you to open up a new retirement account or even transfer an existing retirement account. Then you can purchase alternative stores of value with your retirement like gold, silver, and Bitcoin. In days like this where fraudulent platforms like FTX are collapsing, and traditional banks like Silicon Valley Bank are failing from bank runs. I Trust Capital is still going strong because they do things the right way. You own your assets there. Your assets are always held off balance sheet, and your accounts are never commingled with theirs. They partner with industry leaders like Kitco for their precious metals. They're straightforward about how they keep your assets separate and safe. And if you use my link in the description below, you will get $100 worth of Bitcoin just for signing up. Well, there are a couple of factors at play here. Number one, let's take a look at interest rates. Specifically, interest rates on credit cards have reached a new high. As of May of 2023, the average interest rate on credit cards was over 20%. Now we know that credit card debt in total is at an all-time high of $1 trillion. So we have Americans who have loaded up on more credit card debt than they ever have, while at the same time are now paying a much higher interest rate on that debt than they ever have. Compared to the average interest rate from 2019 through 2022 was about 15%. And the interest rates on credit cards from 2012 through 2016 were down in the 11-12% range. In short, if your total amount of debt stays the same, but the cost of paying that debt from the interest rate going up increases, that means more of your income has to go to pay the same amount of debt, which means you can no longer afford to grow your total amount of debt. So that explains the slowdown in the revolving debt. But what about the drop in the non-revolving debt? Well, this most likely comes down to interest rates as well. This black line at the bottom is the rate on 5-year loans for cars, and it is at a whopping 7.81% right now. Mortgage rates are also continuing to push higher, and we have to go all the way back to 2002 before we see mortgage rates sustained above these levels. So we're seeing multi-decade highs in interest rates on credit cards, car loans, and mortgage loans, the three most popular forms of debt for Americans. Add on top of that the fact that starting September 1st, interest will begin accruing again on student loans, which affects 40 million Americans. Starting in October, those payments will begin again. So let's paint a quick picture of what the average American household is going to be experiencing in just a couple of months. First, there was the money printing in 2020 that made everybody feel rich because it pushed asset prices up. So people went on a spending binge and then a borrowing binge. Right after that, you started to see inflation of goods and services. So the cost of living for average Americans started to go up, but people still felt rich and felt like, hey, this is just temporary. Problem is that continued for much longer than most people were expecting. But instead of lowering their lifestyle, most Americans decided to take on even more debt to maintain their lifestyle despite the higher costs and despite their ballooning debt load. Now the average American household is in a situation where they have a much larger debt load than they've ever had before. Meanwhile, the cost of that debt, the interest rate, the debt service cost is skyrocketing to a place where most American households have never experienced. All that while inflation still remains, meaning their cost of living is not going down in order to make room for their higher debt payments. They still have the more expensive groceries, the more expensive rent, the more expensive gas, the more expensive cost of living, but a much more expensive and a much larger debt load at the exact same time. The question is, how long does this continue? And the answer looks like it's already starting to turn around. For the first time since April of 2020, we see non-revolving debt dropping, and the growth of revolving debt is the slowest pace it's been in a long time. The lack of dollars in circulation available to continue to flow into American households to be able to increase their income to pay off this debt is due specifically to the Fed tightening. That's the whole goal with tightening. Raising rates and decreasing the balance sheet is to make dollars more scarce so that people can't continue to get more and more dollars, which would support longer inflation. This is why the money supply has been falling since April of 2022. And so it looks like the Federal Reserve's tightening is starting to have its intended effect. They make the cost of borrowing so high that it makes people not be able to borrow anymore and have to start paying off some of that old debt. That means they have to reduce their lifestyles, spend less money on other stuff because more of their money has to go to paying the debt. Just in case you haven't caught the drift yet this is deflationary. This is a deflationary force. Yes, there are other forces at play that are inflationary, but this is a very large deflationary force, and I would not be surprised to see the inflation numbers continue to drop. And if you are in the situation that I've been describing, that you feel stuck, you feel broke, you've got an unsurmountable obstacle in front of you of the debt that you have versus the income that you have, I know what that feels like. I've been there before. I know what it feels like to not be able to fall asleep at night because you're broke. You're stuck and you don't know how you're going to get out of it. I've been there before, and guess what? I got out of it. It took me a very long time, and I learned a lot of costly mistakes along the way, and that's why I created Heresy Financial University, because I wanted to be able to help you avoid those costly mistakes, both dollar terms and the cost of time that it took me to get from stuck and broke to financially free. If you're interested, it's a membership program, which means you get access to everything, all of my training library that I create, and all the future courses that I publish on there as well, which includes things like, number one, getting out of debt, which we're talking about, but also how to invest, how to allocate your portfolio in a way so you don't have to be worried about stock market crashes or inflation or deflation, advanced trading strategies, advanced investing strategies, how to hedge your portfolio, how to invest during bear markets, and much more. If you're interested, link is in the description below. As always, thank you so much for watching. Have a great day.